In this video, I'll briefly talk about 8 most easy and common ways that businesses utilize to reduce their tax liability. And this list is by no means a complete one, so feel free to comment what I've missed. And I'll be referring to my notes here throughout the entire video, so I hope you don't mind. Research and development expenses, or R&D for short. By the time you're watching this video, I may have a dedicated video on my channel describing the difference between a deduction and a credit. If I do, feel free to watch it to know what the differences are. And if not, subscribe to the channel so that you don't miss this video, because I will post it very soon. And the reason I'm saying is because R&D expenses are utilized for your tax purposes in 2 ways. You can either claim a deduction, which is a Section 174 deduction, which is basically an amortization of your R&D expenses over the period of 5 years. However, if your expenses were incurred outside the US, your research and development was done outside the US, then those expenses are amortized over 15-year period. And this is a major change under the TCJA of 2017, because prior to that, businesses were able to deduct and write off all R&D expenses in the year that they were incurred. Another method is to claim an actual tax credit under Section 41. However, keep in mind that the tax credit is not available to you for foreign expenses. So if you had foreign R&D expenses, you can only claim the deduction for that. Obviously, you can't claim a double benefit for the same expenses and claim the deduction as well as the credit for the same expenses. And because credits are normally more beneficial to you, I think it's more tax advantageous to calculate the amount of the credit and then reduce your Section 174 deduction by the expenses that were used in the calculation of the credit. So the actual calculation of the credit is very complex and outside the scope of this video. However, I will talk about what the R&D expenses are, because sometimes it may be difficult to classify a specific expense as a research and development expense. So there are 4 requirements that your expenses need to meet in order to be classified as R&D expenses. The first one is qualified business component. These expenses need to improve a business component. What is a business component?
It's any product, process, computer software, technique, formula, or invention that you held for sale, lease, or licensing that you use in your trade or business.
Second requirement is technological in nature, meaning that you rely on hard sciences, including but not limited to physical sciences, chemistry, biology, engineering, or computer science. The third is that these expenses need to be used to eliminate uncertainty. The fourth requirement is process of experimentation, which means that you identify 2 or more alternatives and then you model, design, and or test those alternatives. A qualified business income deduction, which is a 20% deduction of a qualified business income for the years beginning in 2018 and ending in 2025. So this deduction is actually quite complex and outside the scope of the video, so I'll just briefly talk about who is eligible to claim this deduction. The eligible entities are qualified businesses. So if you perform services as an employee, you're not eligible for this deduction. And also, if you're deemed a specified service, trade, or business, that deduction is not available to you. So what is a specified service, trade, or business, or SSTB for short? Well, that is basically a performance of services which relies on your reputation or skill. Services in the fields of health, law, accounting, actuarial sciences, performing arts, athletes, brokerage firms, financial services. Also, SSTB is services consisting of investing and investment management, trading, dealing in securities, partnership interests, or commodities. These businesses are not eligible to claim the QBI deduction. Hiring a family member. Why would you want to hire a family member? Maybe because that family member has a lower marginal tax rate. For example, hiring your children. The IRS does allow you to hire family members, including your children. However, the payment needs to be reasonable. It can't be obnoxious and it needs to be in sync with the services that they provide. Please keep in mind that payments for your children's services are subject to income tax withholdings regardless of age. However, if the child is under 18 years of age and working for you, the parent, for your business, the payments are generally not subject to Social Security and Medicare withholdings, like home office deduction. And I have an entire dedicated video on my channel that you can watch that analyzes the deduction, who is eligible to claim it, how to calculate it, and actually claim it on your tax return. But to briefly describe it right now here is that you can deduct a portion of your house or your home that you use exclusively and regularly for your business, and that place needs to be the principal place of your business where you meet with your clients and customers and deal with patients. In addition, you can use a separate structure in your house as a business place that is also deductible. So next up is using your personal car for business purposes. You have two methods that are available to you. The standard mileage rate method as well as actual expense method. If you're eligible to claim the deduction using both methods, then you need to calculate each and use the one that produces the larger deduction. If you use the standard mileage rate method, you must make sure that you have a written log of the miles that you drove specifically for business, and you can use an app on your phone, or you can actually handwrite depending on what your preference is. The other method, the actual expense method, is the one where you actually need to determine the expense of operating the car for business use. With that method, you will total your expense for gas, oil, repairs, insurance, registration fees, licenses, depreciation or lease payments, and multiply by the fraction of your business miles over the total miles. You also need to keep a log of the business miles that you drove. Please note that other expenses such as parking fees and tolls are deductible regardless of the type of method, standard mileage rate or actual expense method that you use for your car. It's just started pouring like crazy, so I hope the sound quality is still alright. The next expense on the list is actually very important and very complex, so I will only briefly talk about it, and that is depreciation expense. For tax purposes, you're allowed to depreciate and accelerate the write-off of an asset in the earlier years faster than you do for accounting purposes. Let's say you purchased an equipment for $100,000 and you've just paid $100,000 of cash upfront for that equipment. Well, guess what? You cannot write it off as an expense. That equipment gets capitalized on your balance sheet, meaning that you capitalize an asset and you deduct the cash, but you don't get the expense. So for accounting purposes, you will have to depreciate that asset throughout its life based on straight line or based on units produced, depending on what is more appropriate to you. But for tax purposes, it's understandable that you've just spent $100,000 on that equipment, and if you don't write off all or at least a good portion of that amount from your taxable income, you will inflate it way too much, and your tax bill will be unfairly large as a result. And so for tax purposes, you are allowed to depreciate or write off a good portion of the asset in the earlier lives of the asset and less in the later years of the asset. So there are three things that you should know about the US tax depreciation methods. The first one is the MAKERS method, which stands for Modified Accelerated Cost Recovery System. The MAKERS depreciation is based on the type of asset, the life of the asset, and based on the IRS schedules that are available on the IRS website. Again, this is a little bit too complex and outside the scope of this video. But the second portion of the tax depreciation that you should know about is bonus depreciation. A bonus depreciation is a tax incentive that was first enacted in 2022 as a temporary deduction to encourage businesses to invest in and grow the economy after the 9/11 attacks. So the bonus depreciation allowed for even a greater deduction in the first year of the asset's life. Then in 2017, we had TCJA, or Tax Cuts and Jobs Act, which made significant changes to the bonus depreciation rules, and it allowed a 100% write-off of the asset that you purchased in the first year as bonus depreciation. depreciation, which is amazing. If you purchased equipment for $100,000, using that bonus depreciation, you would be allowed to subtract $100,000 and expense it on your income statement, thus reducing your taxable income to the fullest extent. This 100% write-off was available to you from September 27th, 2017 to January 1st, 2023. So, by the way, prior to TCJA, the bonus depreciation maximum amount was 50%. So obviously, starting in 2023, you're not able to deduct 100% of the asset in the first year. There is a phase-out schedule, though, and you will see it on the screen. The next aspect of depreciation that you should know about is Section 179, which allows you to write off all or a part of your asset in the first year as well. However, there are many limitations and many rules, and there are phase-outs as well. Again, Section 179 deduction is outside the scope of this video, but one note is that bonus depreciation and Section 179 deduction are similar in some ways, but very different in so many aspects. The most obvious one is that bonus depreciation allows you a percentage of the asset's cost as depreciation, while Section 179 allows you a fixed dollar amount that you can depreciate and write off on your taxes. And also there are different limitations, different requirements to meet for various assets that I will not be talking about in this video. Retirement. The contributions that you make for yourself or your employees are generally tax deductible. If you have to pay custodial fees as well, those are also deductible if they're not covered by the contributions. And the earnings on the plans are not taxable until they're being distributed by you or your employees. So there are 5 different plans that I will briefly talk about that are available to you as a business owner. So let's say you run your own business and you have no employees whatsoever. You can choose a solo 401k. In that case, you can deduct up to 100% of your income as an employee contribution up to the annual limit. Every year, this limit varies. In 2023, it will be $66,000 plus $6,500 if you're 50 years old or older. You might also be eligible for the employer side of the contributions, depending on your income levels. And those contributions are before tax, so the entire distribution will be taxable. Obviously, 401k plans are also available to you if you have employees, and you can offer that to them as well. The next one is Simplified Employee Pension IRA, or in short, SEP IRA plans. You can save up to 25% of your income, but the limitations are the same as I've just described for solo 401k. SEP plans are simplified, as the name suggests, and they're simplified in a way that you don't have to set up a profit sharing or money purchase plan with a trust. You can just adopt an SEP agreement and make contributions directly to the traditional IRAs or traditional annuity IRAs for yourself and your employees. Generally, SEP IRA contributions are not included in income, and therefore the distributions are normally fully taxable. SEPs have low startup and operating costs, and they can be established using a 2-page form 5305-SEP. And in addition to that, you can decide each year how much you will contribute, which gives you flexibility when business conditions change. The next one I'm pretty sure all of you have heard and know of is IRAs, individual retirement accounts, which are trusts or custodial accounts that you set up with banks or similar entities that act as trustees or custodians. Those are easy to set up and maintain. Contributions to the IRAs are normally tax deductible. Therefore, distributions once you retire and take the money out are fully taxable unless you make non-deductible contributions. So the next one is a Roth IRA. It is a tax-advantaged personal savings plan where contributions are not tax deductible, but distributions are tax-free. And last but not least is simple IRA plans. Those are generally available to you if you had 100 or fewer employees who received at least $5,000 in compensation last year. There are 2 types of simple IRAs. I'll just briefly mention them, but I won't be describing. There is a simple IRA plan, and there is also a simple 401k plan. Employers as I said, must match the employee contributions dollar for dollar up to 3% of an employee's compensation, or make fixed contribution of 2% of compensation for all eligible employees, even if the employees choose not to contribute. Generally, simple IRA contributions are not included in an employee's income when paid to the IRA, and therefore the distributions are fully taxable when the employees receive them in later years. Health insurance. So if you're a W-2 worker, you normally can share the cost of health insurance premiums with your employer. The deduction normally is limited to the net profit or earnings from the business under which the insurance is established. And the deductibility extends to self-employed individuals for medical, dental, vision, and long-term care insurance premiums. You can also claim the deduction for your spouse and any qualifying dependents age 26 or lower at the end of taxable year. Generally, if you run your own business and you have no employees, you're not eligible for the group coverage health plan, and you'll have to purchase yours from a marketplace for individuals and families. A group insurance health plan is available to you if you do have employees, and you can purchase it from the Small Business Health Options Program or SHOP, or otherwise a private insurance company. On this channel, my goal is to empower you by uncovering the mysteries of US income tax and broadening your perspectives. While this video and the channel overall are informative in nature, they're by no means a complete tax guide and should never be taken as professional advice. I hope to see you in the next video.